What's up, everyone? Welcome to another episode of Finance Simplified, the official podcast for Street Fins. We're here to break down the world of finance for you to understand from a relatable perspective with discussions with experts. My name is Rohan, and this is episode 35. I'm joined by my co-host Alex. Any updates lately?
Nothing too crazy. Had a great time at the Yankees game today.
That's great. The summer's just flown by so quickly, and it's been fun, but obviously I wish I had more time.
Couldn't agree more. But I'm also looking forward to returning to campus and reuniting with friends.
That's awesome. So Alex, the topic of this episode is simplifying sustainable investing. What is sustainable investing and why is it so important?
Well, sustainable investing is just like regular investing, but it also includes factoring in sustainability characteristics.
Yep, and as anyone who has been following the investing news for the past few years has seen, sustainable investing, which could go by ESG investing in certain contexts, has become quite popular. We're actually going to be talking to a co-founder of one of the most well-known sustainable investment firms today. We'll be making this topic a two-part conversation, so this episode is part one, and we'll be releasing part two in about 2 weeks from when this drops. As always, if you're learning from our episodes, we'd be eternally grateful if you gave us a 5-star rating and review on Apple Podcasts. Even if you're listening to this on another platform, as long as you have an Apple account or device, you can support us with the rating. We welcome any and all feedback from our listeners, so get in touch with us to let us know how we're doing and what you would like to see from us going forward. We'll be teasing the next guest at the end of part 2. So, let's just get to simplifying. Welcome to Finance Simplified, the official podcast for Street Fins created by students that simplifies the seemingly complex
and confusing
world of money. We're your hosts, Rohan
and Alex.
Sustainable investing has been making the rounds in the news these past few years due to more attention on climate change and social agendas.
Sustainable investing.
Sustainable investing.
Sustainable investing.
Our guest today is David Blood. He co-founded Generation Investment Management with former Vice President Al Gore and several other investors. Generation Investment Management is known as one of the pioneers and leaders in the sustainable investing space. David was also the CEO of Goldman Sachs Asset Management. His background and career are both so impressive that I think I'll just let him introduce himself.
Sure. I'm not sure I would consider myself terribly accomplished, but I am the senior partner of Generation Investment Management, and I've been in the finance industry, for over 40 years now, starting in investment banking, and was part of founding Generation Investment Management nearly 19 years ago. 19 years ago next month, I guess in September. So been in the finance world for a long while.
Yeah, I mean, Generation's known as this sustainable investment firm that was co-founded, you and Al Gore, former vice president. So could you talk about how that connection happened? It's not every day that you see someone connecting with the former, vice president and starting a financial firm focused on a specific niche. So could you talk about how that whole process of co-founding Generation happened?
Sure, but it's very important to say that it wasn't just Al and myself. There were 7 founders of Generation, all of whom have been critical members of our organization over these years. It just so happens that Blood and Gore, as a combination of names, has been memorable, I guess, if you will. But we founded the firm with really 2 objectives in mind. The first was to hopefully deliver strong investment results for our clients. And secondly, to promote sustainable investing in the capital markets broadly defined. And when we started this journey, the notion of sustainable investing, or ESG, was really quite nascent. There were others who started before us for sure, and we have benefited by their great work, but we were early proponents, if you will, into sustainable investing. And in our investment framework, and I really want to focus on this for a few minutes, if that's okay, is based on 3 points. The first is long-term investing is best practice, and I know you all know that well and talk about it. Secondly, though, that sustainability, broadly defined to include issues like the environment, issues like climate change, issues like health, issues like inequality, issues like development, challenges of water, challenges of governance, that these broad sort of macro trends or issues are relevant to to economies and are drivers of economies, increasingly interlinked drivers of economies. And because they're drivers of economies, need to be understood in capital allocation. And that thirdly, environmental, social, and governance factors are tools to help us understand the quality of business and quality of management. So this investment framework, we believe, has helped us deliver strong investment results, both in public and private markets over the course of these last 18 years. And we define sustainable investing as intentionally allocating capital to businesses that are driving a net zero, prosperous, equitable, healthy, and safe society. So we have an end game in mind as we think about allocating capital. But it starts with an investment framework that is not dissimilar to others, except that we're probably broader in what we think is relevant to the capital allocation process because, of course, we're long-term investors.
Okay, well, that's a great overview. And, I think that's going to be the main focus of this episode is those two things, ESG and sustainable investing. I think for our viewers, there's a lot of confusion about what exactly falls under that category. I think, those are terms that are very loosely thrown around. And maybe you could contextualize it even more by describing what is sustainable investing not? How does it differ from impact investing, for example? Would you be able to provide some context there?
Yes, well, that is a terrific question. And there are a number of sustainable investing challenges. And one of the biggest ones is that there seems to be multiple definitions and, as you said, many confusion around what it really means and a lot of different acronyms, et cetera. There are a handful of points that we believe and I think might be helpful to share. The first is sustainable investing. And remember, we define sustainable investing as intentionally allocating capital to a sustainable society. So we would tell you that all investing is hard and sustainable investing is hard. It does not lend itself to checklists, a single score. So when you hear about an ESG score or a sustainability score or a sustainability index, we think that those are challenged because there are trade-offs, and this is the second point, there are trade-offs around what's more important, your environmental impact or how you operate your business from a governance or society perspective. Those are difficult challenges, and you need to think it through carefully. And how you allocate capital, by the way, may change over time depending upon other circumstances. The notion that everything is a win-win. Well, there are win-wins, but there are often challenges and trade-offs. And so it's not always a win-win. We get confused by the notion of impact investing because all investing has impact. All businesses have impact. And increasingly, we think impact needs to be measured and reported. And certainly our clients believe that impact must be measured and reported to them. And we think increasingly capital allocation will be based upon risk, return, and impact. Often people say, well, sustainability and ESG are not delivering societal change, and therefore we shouldn't pursue it. Well, we would say, fair enough. Sustainable investing is not, it's necessary, but it's not sufficient. There are other aspects of society, including, very importantly, government policy that needs to be part of the solution. But importantly, the lack of government policy doesn't absolve us as investors or as business people from the responsibility to act. I think lastly, it's very important to say the sustainable investment framework that I've outlined is not a political movement. It's actually a rigorous and relevant economic framework consistent with fiduciary duty. So we don't think of sustainability as an industry. We don't think of ESG as an industry. We think of it as a rigorous traditional investment framework that is consistent with fiduciary duty, but recognizes that sustainability drives economies and therefore must be understood, and that the broader soft issues, whether it be environmental, social governance issues, drive the long-term success of business and also needs to be thought about in how you allocate capital. And so sustainability is all we do at Generation. It is, we hope, consistent with our mission of delivering strong investment results for clients, and of course, our mission of promoting sustainability in the capital markets.
Yeah, that's a really, really solid overview. And, one thing I think that was very consistent in your answer is this idea that it's very hard to measure these impacts. Like, you cannot use kind of a single metric, an ESG score. And your co-founder, Al Gore, is quoted saying, Generation wants to make an eventual, quote, net zero, prosperous, equitable, healthy, and safe world. So measuring that net zero part is probably quite intuitive because we have emissions data. But how would you measure kind of subjective goals such as making the world more prosperous, equitable, healthy, and safe when people have different interpretations, and probably even your investors? And how do you find bounds on that?
Well, there's a very good question, and we're constantly working on how to, I think, more effectively report impact in our portfolios. Some of our public portfolios are probably a little harder to develop the matrices, although they increasingly are being done, and I'm going to come back to that in a second. Our private portfolios is a little bit easier because the businesses tend to be smaller and more focused, and so you can identify what problem they're trying to solve in a more concentrated way. But we also have people at Generation who've been very involved in helping to establish the different sustainability matrices and measurements. And you may be aware that certainly outside the United States, there's a group called IFRS, which is basically the accounting standard boards around the world, except for the United States. Well, the accounting standard boards has merged with the sustainability standard boards. And we now have both of these sort of initiatives are under one roof and increasingly will be integrated. So businesses, there's something in the United States called SASB, Sustainability Accounting Standards Boards, and that initiative is now being folded into the broader accounting standards initiatives, so that increasingly, succinctly to answer your question, we will have more standard measures to report on the social aspects of sustainability or ESG in how businesses operate. But you're also quite right to say that, again, these are early days. Some reporting will be challenged because we won't have the data. Some reporting will be challenged because what you think is a proper impact might not always line up to what I think is a proper impact. And that's okay. It's okay to have these discussions, because remember, in investing, again, it's hard, and people like to think that all investing is really just about numbers. Well, numbers are not always what they seem to be. You can torture numbers long enough and they'll tell you whatever you want them to tell you. So when you look at a balance sheet or an income statement, we kind of get lulled into the fact, well, these are numbers and therefore they're factual. Well, as you all know from your investing experiences, a lot of those numbers are estimates and they're judgments. And that is true for some of the sustainability factors as well. So reporting and impact, these are journeys that we're on. We must get better for sure if we want to drive to the net zero, clean, healthy, safe, prosperous, and fair societies.
Yeah, that's a very thorough response. And this next section of questions is going to be more about tying what you've said already about sustainable investing, the frameworks, this idea that sustainability is all you're focused on, to some more, I guess, established, more talked about theories about just markets in general. So the first one I have is, what is the business case for sustainability and ESG? That's something that I've read on Generation's website and some of the articles. What is that case, and why was this case not being able to be made in the past? And what is different about today that is making this case to not only be made, but to succeed in some cases?
Well, we thought it should have been made forever. So when we started Generation, we recognized through our own journeys and our experiences as investors and capital markets professionals that the investment community wasn't incorporating all of the inputs necessary to assess a business and a management team. And that's why we founded Generation, is we felt that there was an opportunity and a necessity to do things a bit differently. And we wanted to share that insight because we thought that we could help drive. Remember, we're a mission-driven organization. We have two missions: one, to deliver strong investment results; second, to promote sustainability in capital markets. And they're interlinked, and we must do both in terms of how we're building our business. So I think we were fortunate to be early in this discussion, but there wasn't a shift in economic circumstances that allowed it to be talked about. It was, I think, increasingly a recognition that it should be talked about. And by the way, the whole question of GDP, that has been a conversation since the 30s. And the man who established GDP as a concept, he made it very clear that the tool that I've helped develop is not complete. It doesn't include critical factors to the long-term success of economies, like climate or like resource depletion. And so we've been aware of the deficiencies in our tools for a long while. I knew when I started working 40 years ago that the balance sheets of businesses didn't fully reflect the culture of the organizations, and that understanding the success of businesses went beyond just the balance sheet. So it's not like something has just happened in capital markets. We've known that the tools weren't sufficient for a long while, and we've been evolving these tools over many years. And that's why sustainability and ESG has resonated in many ways, because people recognize there's no evidence to say that incorporating sustainability or ESG into your investment process is going to hurt your investments. And so on that basis, everybody recognizes being holistic is a good idea. And we think it's a superior way to deploy capital.
Right. This next question I have comes from just general sentiments I've seen about ESG. And there's this idea that sustainability practices can be implemented only by companies that can afford that luxury, in a sense that they are supposed to reach a certain level of fundamental strength in either earnings or balance sheets, any sort of fundamental metrics. In other words, do you think that sustainability practices are limited to those companies that can afford it as an add-on to what they're currently doing? And if the former is true, does that sort of lead to higher multiples for those companies in the markets because they already have achieved a certain level of fundamental strength to be able to take on these extra, sustainability practices if they're able to do so? If that makes sense.
Well, it's a great question, Rohan, but here's why it's a false choice. So if the premise of that question is sustainability or ESG is not relevant to the success of business, it's a nice to have. And we don't agree with that. We believe that the very best businesses will take a long-term perspective and recognize that how you treat your employees, the culture of the organization that you develop, how you operate in your community, your environmental footprint, the waste you have, how you govern yourself. We believe that best practice requires that you consider those questions. And the very best businesses, both publicly and privately, do, large and small. And that's the core premise. So when people think of ESG as a thing or as sort of an industry, we say no. Sustainability and ESG are part of the core fundamentals of how you run a great business. And therefore, every business, every capital allocation discussion should incorporate the broader challenges of sustainability and ESG. But again, remember, it's hard. There are trade-offs. You're learning all the time around how to manage those trade-offs. But that's true of all investing and all business. There are very few black and white issues in a capital allocation or in business.
Right. I think this is a perfect lead into my next question. It's just, you're talking about focusing within sustainable investing on how companies operate in terms of their culture, how they're treating the environment, and the impacts of those decisions on, bottom line results and really the success of the company in both a financial sense, but in a societal sense as well. So this next question is more about how you feel people can develop an edge within sustainable investing if we're supposed to follow the line of reasoning that If you were to focus on these factors of company culture, of treatment of the environment, of anything that's within this umbrella of sustainable investments and relevant factors, how do you develop an edge by understanding those factors? And are there essentially inefficiencies in this market that allow you to develop this edge?
Well, it's consistent with how you develop edge in all of the active investing strategies or styles, if you will. And it's based on experience. It's based on doing deep research. And very importantly, being humble and recognizing that you've got to learn all the time. And investing, as you know, is the very best investors in the equity markets, for example, are right maybe 55% of the time, 60% of the time, maybe it's 52% of the time, which means they're wrong a lot. And learning from those mistakes matter. It's one of the few industries where having gray hair helps, actually, because experience matters. And the very best investors, I think, are those who are humble and are willing to and are able to be inquisitive and curious and learn from their mistakes. Now, we at Generation have always wanted to share the insights of sustainability because we felt that would help promote others to do the same sort of work that we're doing. And oftentimes I've received questions of, well, why are you sharing this philosophy? And it comes back to your question, which is you can have a framework, but the judgment of the outputs of that framework and the assessments is really judgment, and that's based on experience. And so there are some of my colleagues have, particularly who are new to the investment industry, kept saying, well, how do we accelerate a 3-year track record or a 5-year track record? And I would always say and do say, well, turns out it takes 3 years to get a 3-year track record, 5 years to get a 5-year track record, 10 years to get a 10-year track record. And the longer you are at it, and assuming you're learning along the way and humble enough to continue to be inquisitive, the better off you're going to be.
Yeah, that makes a lot of sense. And, you talked about sustainability being, it's a must essentially for Generation or any sustainable investment firm to actually take a position or consider taking a position in any company or asset. Sustainability, needs to be there. By the same token of sustainability being a requirement for taking a long position in a company, would you see the lack of sustainability as a reason to short a company? I'm not sure how much Generation deals with shorting, if at all. But would you consider that as a reason to short a company?
So Generation does not. Our investment philosophy and strategy is based on finding great businesses, both publicly and privately, and hopefully owning them for a long period of time. And so shorting is definitely not part of what we do. But we do know that there are some organizations who will use shorting companies as a way to either to promote change of them or to drive alpha. And so it's a perfectly legitimate strategy. If you think a business is unsustainable and the market will recognize that, deploying capital that way makes sense. Similarly, engaging with businesses that are not as robust or long-term or sustainable as they should be is absolutely essential in terms of building businesses over the months and years ahead. But our own strategy is a little bit different.
Yeah, that makes sense. And obviously shorting isn't something that everyone has No,
it's a very different skill. So
yeah.
For us, we are doing deep research in why we want to own a business. It's a different discussion as to why you might not want to own a business. It's not quite the same as just saying, well, just turn it around. It's a different discipline.
Yeah. And let's talk about one of these businesses that I saw that was in one of the growth equity portfolios. I saw this company called Asana, which is creating workplace collaboration software. And, at first, when you're thinking about sustainability, we think about climate and renewable energy and, the first kind of sectors that come to mind. When the direct sort of tie to like carbon emissions and those like other factors that you mentioned about like inequality, like when they're not as clear cut from like, let's say the product of a certain company, which is like workplace collaboration software, how do you sort of dig deeper and find those links between like that one company and its impact on the environment? Like how exactly does that analysis work?
So the first thing I need to say is I can't talk about a specific company. So let me just talk about, in general, the answer to your question, which is a good one, which is number one, remember we have an end goal. we're saying that we are trying to allocate capital to businesses that are driving to net zero, prosperous, equitable, or fair, healthy, and safe society. So that is our end goal. So that's our North Star, if you will. And so now we're allocating capital in the public market against the broader opportunity set of public equities. And in the private marketplace, in our growth equity strategy, we're allocating to either human health, financial fairness, or the environment, if you will, planetary health. And so we set those broader sort of categories. And then what we're doing is we're doing deep research around the types of industries or businesses we want to own within those different constraints. And as we drill into companies, what we're trying to do is understand what drives the long-term success of those businesses. But we're being holistic around how we're assessing what drives the long-term success of those businesses, again, within the construct of we have an end goal. We're trying to drive towards a society that is sustainable. But you're right to say, so sometimes when people are assessing our portfolio, for example, they'll say, oh, you own a technology business. How is that sustainable? Well, fair enough. Perhaps a technology company doesn't have a huge carbon footprint, and therefore people could say, well, how does that address the challenges of climate? Well, when we think about how we're transitioning to net zero, we're going to touch every industry. When we think about how we're dealing with company or fairness and economic equality, that's across multiple industries. And so the questions of sustainability and the questions of ESG are not solely environmental questions. They're not solely social questions. They're complicated, they're interlinked, and you need to think about them holistically. You need to think about them in a systems view, and you need to think about them in a full life cycle view as well.
Hey everyone, that was the end of part 1 of our 2-part interview with David Blood on simplifying sustainable investing. We'll be releasing part 2 of our interview in about 2 weeks from when this releases. But the first half of the conversation was absolutely incredible. What were some of the key takeaways?
One key takeaway is that sustainable investing is all about blending the financial fundamentals of a company with the impact it's making on society and the world. It's what David constantly refers to as, quote, being holistic. That's a huge characteristic of sustainable investing.
One thing I found interesting is his view that sustainability is a driver of economies. If we're to really think about the goal of sustainability, or ESG, in its most pure form, it's to increase the well-being of people around the world. Throughout history, a certain level of well-being, safety, and security needed to exist in societies for progress to even have a chance of happening. So I think it's important to note that sustainable investing can really focus deeply on those improvements in societal well-being.
Moreover, I think it's worth noting how David sees sustainable investing as a framework as opposed to an industry, and how he doesn't differentiate between sustainable investing and investing. It has the same goal of achieving returns, but with the idea that sustainability can contribute to a business's success and to returns.
Agreed. Well, Alex, that wraps up our part 1 conversation and takeaways. What can we expect from part 2?
We can expect to talk about measuring sustainability goals, careers in sustainable investing, the latest controversies in sustainable investing, and much more.
Part 2 will be dropping in about 2 weeks from now. We'll talk to you all then. Hey guys, I want to thank you so much for listening to this episode of the podcast. It truly means the world to us. If you like this episode and others, let us know by subscribing and giving us 5 stars on Apple Podcasts and following us on Spotify. Share us with your friends and check us out on Instagram and Twitter, both at StreetFins. You can also follow me on Twitter at Rohan Invest. If you'd like to get in touch with us, please email fspodcast@streetfins.com. Thanks once again to David Blood for his insights today. I hope you understand the topic of sustainable investing in a more simplified way. This episode was produced by the incredible Jeffrey Lee. Once again, we're really happy that you're taking the initiative to learn finance and to better your future. If you haven't already, we highly encourage you to check out streetfins.com for articles, videos, and other content. Join the StreetFins community and tell your friends about us so that they can learn about finance too. We'll talk to you next time on Finance Simplified.